Okay, wait a minute and let me just check if the audio and video is working fine or no, and then I'll begin. Just check if the audio and video is working. Alright, so everything is working fine. Let us just begin. Cool. Shall I move the camera a little bit? Okay, let's just begin. Alright, so last time we have already read about this. Let me just keep it over here just in case if I'm getting any, you know, those kind of stuff. To optimize or not. So we are reading this ninth chapter, which is about moving averages from the book Technical Analysis of the Financial Market, and we are at the page number 211 out of 501, and the topic is to optimize or not. The first edition of this book included the result of extensive research produced by Merrill Lynch, which published a series of studies on computerized trading techniques applied to the future market from 1978 to 82. Extensive testing of various moving averages and channel breakout parameters was performed to find the best possible combination in each future market. The Merrill Lynch researcher produced a different set of optimized indicator values for each market. Most charting packages allows you to optimize system and indicator instead of using the same moving averages in all markets. All right. For example, you could ask the computer to find the moving average or moving average combination that have worked the best in the past for the market. That could also be done for daily and weekly breakout systems and virtually tell technical indicators included in this book. Optimization allows technical parameters to adapt to changing market conditions. Oh, okay. The first edition of this book included most charting packages allow you to optimize system and indicator instead of using the same moving averages in all market. For example, you could ask the computer to find the moving average or moving average combination that have worked best in the past or that market. That could also be done for daily and weekly breakout systems and virtually all technical indicators included in this book. Optimization allows technical parameters to adapt to changing market conditions. Some argue that optimization helped their trading results and others that it doesn't. The heart of the debate centers on how the data is optimized. Researchers stress that the correct procedure is to use only part of the price data to choose the best parameters and the other portion to actually test the results. Okay, makes sense. Testing the optimized parameters on out of sample price data helps ensure that final result will be closer to what one might experience from actual trading. The decision to optimize or not is a personal one. Most evidence, however, suggests that optimization is not the holy grail. Some think it to be. I generally advise traders following only a handful of markets to experiment with optimization. Why should treasury bonds? It's all around me. Okay, welcome to the live stream. It's all around me. Alright. Why should treasury bonds on the German mark have the exact same moving averages as corn or cotton? Stock market traders are a different story. Having to follow thousands of stocks argues against optimization. If you specialized in handful of markets, try optimizing. If you are a journalist who follows a large number of markets, use the same technical parameters for all of them. Now we are at the end of this particular chapter. We have presented a lot of variation on the moving averages approach. Let's try to simplify things a bit. Most technicians use a combination of two moving averages. Those two averages are usually simple averages. Although exponential averages have become popular, there is no real evidence to prove that they work any better than the simple average. The most commonly used daily moving average combination in future market are 4, 9, 9 and 18, 5 and 20 and 10 and 40. Stock traders rely heavily on a 50-day or 10-week moving average for longer range stock market analysis. Popular weekly moving averages are 30 and 40 weeks or 200 days. Bollinger Bands make use of 20-day and 20-week moving averages. The 20-week averages can be converted to daily charts by utilizing a 100-day average, which is another useful moving average. Channel breakout system work extremely well in trending markets and can be used on daily, weekly, and monthly charts. Again, this is not a hard and fast rule. You can change the things according to your, what I can say, preference, and according to your experience, and according to your uh, like requirements from the market where you are trading. The adaptive moving average. One of the problems encountered with moving average is choosing between a fast or slow average. While one may work better in a trading range market, the other may be preferable in a trending market. The answer to the problem of choosing between the two may lie with an innovative approach called the adaptive moving average. Perry Kaufman presents this technique in his book Smarter Trading. The speed of Kaufman's adaptive moving average automatically adjusts to the level of noise or volatility in a market. The AMA or adaptive moving average. Okay, AMA. AMA stands for adaptive moving average. Moves more slowly when markets are trending sideways, but then moves more swiftly when the market is trending. That avoids the problem of using a faster moving average and getting whipshot more frequently during a trading range and using a slower average that trails too far behind a market when it's trending. Kaufman does that by constructing an effective efficiency ratio that compares price direction with the level of volatility. When the efficiency ratio is high, there is more direction than volatility, favoring a faster average. When ratio is low, there is more volatility than direction, favoring a slower average. By incorporating the efficiency ratio, the AMA, that is adaptive moving average, automatically adjusts to speed most suitable for the current market. Alright, that is also something that you can try. Moving averages don't work all of the time. They do their best work when the market is in trending phase. They are not very helpful during trendless period. So this is like the summary, right, of this particular chapter, correct? And in which we understood what the moving averages are, and not just that, we are also understanding why they are important, and under which market condition it can work properly, and under which market condition we have to look for some other better options. So that's what the author John J. Murphy is trying to say. Moving averages don't work all of the time, so they are more suitable in trending market. So either it can be uptrend or downtrend. They're not very helpful during trendless periods. Trendless periods period or like the sideways market, one of the same thing. When prices trade sideways, fortunately there is another class of indicator that performs much better than the moving average during those frustrating trending ranges. They are called oscillator, and we'll explain them in the next chapter. Alright, so now we are going to understand about oscillators and contrary opinion. So let's understand the introduction first. In this chapter, we are going to talk about an alternative to trend following approaches, the oscillator. The oscillator is extremely useful in non-trending markets or sideways market where prices fluctuates in a horizontal price band or trading range, creating a market situation where most trend following systems simply don't work that well. The oscillator provides the technical trader with a tool that can enable him or her to profit from those periodic sideways and trendless market environments. The value of the oscillator is not limited to horizontal trading ranges. However, used in conjunction with price charts during trending phases, the oscillator becomes an extremely valuable ally, ally by alerting the trader to short-term market extremes. The value of this. Commonly referred to as overbought or oversold condition. The oscillator can also warn that a trend is losing momentum before that situation became evident in the price action itself. That's the game, right? If you can figure out the actual move before it happens, then you are going to earn. Alright, so that means if you will get to know somehow with the help of indicator, oscillator, moving average, or whatever, if you can identify the market is going to be trendless in upcoming times, or like it will go uptrend, it will go downtrend. If you can realize it a bit early, then you're going to act accordingly, and then you can save money or get money, or get profits and stuff. The oscillator can also warn that a trend is losing momentum before the situation becomes evident in the price action itself. So before price action, it can help you to identify that the current trend, whatever direction it is moving, it is going to end soon, right? Oscillators can signal that a trend may be nearing completion by displaying certain divergences. We'll begin by explaining first what an oscillator is and the basis for its construction and interpretation. We'll then discuss the meaning of momentum and its implications for market forecasting. Some of the more common oscillator techniques will be presented from the very simple to the more complicated. The important question of divergence will be covered. We'll touch on the value of coordinating oscillator analysis with underlying market cycles. Finally, we will discuss how oscillators should be used as part of the overall technical analysis of a market. Alright, so that was the basic introduction of oscillator. Let's understand it better now. Oscillator uses in conjunction with trend. The oscillator is only a secondary indicator in the sense that it must be subordinated to basic trend analysis. As we go through the various types of oscillator used by technicians, the importance of trending in the direction of the overriding market trend will be constantly stressed. The reader should also be aware that there are times when oscillators are more useful than at others. For example, near the beginning of important moves, oscillators analysis isn't that helpful and can be misleading. Towards the end of market moves, however, oscillators become extremely valuable. We'll address these points as we go along. Finally, no study of market extremes would be complete without a discussion of contrary opinion. We'll talk about the role of contrarian philosophy and how it can be incorporated into market analysis of trading. Interpretation of oscillator. While there are many different ways to construct momentum oscillator, the actual interpretation differs very little from one technique to another. Most oscillators look very much alike. They are plotted along the bottom of the price chart and resemble a flat horizontal band. The oscillator band is basically flat, which while prices may be trading up, down, or sideways. However, the peaks and troughs in the oscillator coincide with the peaks and troughs on the price chart. Some oscillators have a midpoint value that divides the horizontal range into two halves, an upper and a lower, depending on the formula used. This midpoint line is actually a zero line, usually a zero line. Some oscillators also have upper and lower boundaries ranging from 0 to 100. Alright, general rules for interpretation. As a general rule, when the oscillator reaches an extreme value in either the upper or lower end of the band, this suggests that the current price move has gone too far too fast and is due for a correction or consolidation of some type. As another general rule, the trader should be buying when the oscillator line is in the lower end of the band and selling in the upper end. The crossing of the midpoint line is often used to generate buy and sell signal. We'll see how the signal general rules are applied as we deal with the various type of oscillator. The three most important uses for the oscillator. There are three situations where the oscillator is most useful. You'll see that these situations are common to most types of oscillator that are used. The oscillator, the first one, the oscillator is most useful when its value reaches an extreme reading near the upper or lower end of its boundaries. The market is said to be overbought when it is near the upper extreme and oversold when it is near the lower extreme. This warns that the price trend is overvalued or overextended and vulnerable. A divergence between the oscillator and the price action when the oscillator is in extreme position is usually an important warning. The crossing of the zero or midpoint line can give important trading signals in the direction of the price trend. Cool. So in this particular direction, this one is obviously the chart or the candlestick or whatever it is, basically telling about the current price movement. And this one is oscillator. The 10-day momentum line fluctuates around a zero line. Reading too far from the zero line are overbought, while okay, so this is the 10-day momentum line. The 10-day momentum line fluctuates around a zero line. Reading too far above the zero line are overbought. Too far above are overbought, while values too far below the line are oversold. Momentum should be used in conjunction with the trend of the market. So too far from the middle line, 0 point is overbought, and too below is oversold, and the market will act accordingly. Measuring momentum. The concept of momentum is the most basic application of oscillator analysis. Momentum measures the velocity of price changes as opposed to the actual price level themselves. Market momentum is measured by continually taking price difference for a fixed time interval to construct a 10-day. Alright, to construct Pragya Rathwar. Alright, welcome to the stream. I know it is not helpful to you. So, to other people, they are just my sisters and they are just randomly sending hi. They have no interest in trading at all, but they are just trying to support, I guess. Whatever. Alright, welcome to the live stream. To construct a 10-day momentum line, simply subtract the closing price 10 days ago from the last closing price. This positive or negative value is then plotted around a zero line. The formula for momentum is alright. So there is this formula to measure the momentum. Momentum basically tells in which direction the market is trying to move. And obviously, if we'll try to move in the direction of the market and if we can ride the trend, then it will ultimately tell us that trend is a friend is the general calling in the market, right? So if you'll ride the trend and you'll enter at the right time, you'll exit at the right time, you're going to get the profits. So it is as simple as that in simple words. But yeah, for understanding the true trend, you have to understand the momentum, which will tell you the direction of the market. So the concept of momentum is the most basic application of oscillator analysis. Momentum measures the velocity of price changes as opposed to the actual price level themselves. Market momentum is measured by continually taking price difference for a fixed time interval. To construct a 10-day momentum line, simply subtract the closing price 10 days ago from the last closing price. This positive or negative value is then plotted around a zero line. The formula for momentum is m is equals to v minus vx, where v is the latest closing price and vx is the closing price x days ago. For example, if you are checking it for 10 days ago, so it will be like v10. So v will be the latest closing price, and v10 means the closing price 10 days ago. So for an example, today let's say the closing price is 100 and 10 days ago the closing price was, let's say, 50. So the momentum will be 50. That means the market moved 50 points above the closing that had happened 10 days earlier. So where v is the latest closing price and vx is the closing price x days. A comparison of 10 and 40-day momentum lines. The longer version is more helpful in catching major market turns. See circles. So these are the circles, right? So they are helpful to catch the market actions, right? Cool. 10-day momentum, 40-day momentum. So the longer one, that means the 40-day momentum is helping is more helpful in catching major market turns. So from this point the market turned, right? From this point it came in the downward direction. Again, from this point also it turned. From this point again it turned. So yeah, that's there. If the latest closing price is greater than that of 10 days ago, in other words, prices have moved higher, then a positive value would be plotted above the zero line. If the latest close is below the close 10 days earlier, prices have declined, then a negative value is plotted below the zero line. So that is very easy to understand, right? It is self-explanatory. Like for an example, 10 day ago the closing was 50 and now the closing latest closing is 30. So obviously 30 minus 50, it will be minus 20. That means the market has moved in the downward direction. So we'll draw it below the zero line. And again, the earlier example, when the latest closing is, let's say, 100 and 4 days ago the closing was at 50. So 100 minus 50 will become 50. So that means the market has moved 50 points above the 10 last, like the previous 10-day ago closing. So this is the formula that I am trying to utilize. Okay, m is equals to v minus vx. Vx is the closing x day ago and v is the latest closing. M is defining the momentum. Alright, so you have to put it in this manner. If you're getting a positive value, that means the market has moved up and you'll draw it above the zero line. And if the value is negative, that means the market has moved down. That's why there is this negative value, and the momentum will also come as negative. While the 10-day momentum is commonly used, okay, while the 10-day momentum is commonly used time period for reasons discussed later, any time period can be employed. See figure 10.1a. A shorter time period such as 5 days produce a more sensitive line with more pronounced oscillators. A longer number of days such as 40 results in much smoother line in which the oscillator swings are less volatile. Momentum measures, like this particular figure we have already understood, right? So here this is the 41, this is the 10-day one. Momentum measures rate of ascent or descent. Let's talk a bit more about just what this momentum indicator is measuring. By plotting price difference for a set period of time, the chart is studying rates of ascent or descent. If prices are rising and the momentum line is above the zero line and rising, this means the uptrend is accelerating. If the upslanting momentum line begins to flatten out, this means that the new gains being achieved by the latest closes are the same as the gains 10 days earlier. While prices may still be advancing, the rate of ascent or the velocity has leveled off. When the momentum line begins to drop toward the zero line, the uptrend in prices is still in force but at decelerating rate. The trend is losing momentum. Okay. If the up slanting momentum line begins to flatten out, up slanting momentum line begins to flatten out. This means that the new gains being achieved by the latest closes are the same as the gains 10 days earlier. That's why it is getting flattened out, right? While prices may still be advancing, the rate of ascent or the velocity has leveled off. When the momentum line begins to drop toward the zero line, the uptrend in prices is still in force but at a decelerating rate. The uptrend is losing momentum. When the momentum line moves below the zero line, the latest 10-day close is now under the close of 10 days ago and a near term downtrend is in effect. And incidentally, the 10-day moving average also has begun decline. As momentum continues to drop farther below the zero line, the downward trend gains momentum. Only when the line begins to advance again does the analyst know the downtrend is decelerating. It's important to remember that momentum measures the difference between prices at two time intervals. In order for the line to advance, the price gains for the last day's close must be greater than the gains of 10 days ago. If prices advance by only the same amount as 10 days ago, the momentum line will be flat. If the last price gain is less than that of 10 days ago, the momentum line begins to decline even though prices are still rising. The last price gain is less than that of 10 days ago. Hmm. This is how the momentum line measures the acceleration or deceleration in the current advance or decline in the price trend. The momentum line leads the price action. Because of the way it is constructed, the momentum line is always a step ahead of the price movement. It leads the advance or decline in prices, then levels off while the current price trend is still in effect. If then begins to move in the opposite direction as price begins to level off. The crossing of the zero line in a trending signal. The momentum chart has a zero line. Many technicians use the crossing of the zero line to generate buy and sell signal. A crossing above the zero line would be a buy signal because it will signify there is this initiation of the uptrend, and a crossing below the zero line, again it is a sell signal because the market is below the zero line. That means the market has initiated a downtrend. So that means you have to, if you are in a, let's say, above position, if you are going in a long direction, that means now you have to liquidate your position, and if you are a seller you have to initiate your position, a sell signal. It should be stressed here again, however, that basic trend analysis is still overriding consideration. Oscillators analysis should not be used as an excuse to trade against the prevailing market trend. Buy positions should only be taken on crossing above the zero line if the market trend is up. Short position should be taken on crossing below the zero line if the price trend is down. See figure 10.2a and b. So this is figure 10.2a. So this is the market. It was almost like sideways till this point, and after this point it went on downtrend. And in the momentum line also, after this point it crossed the zero line and it went in the downward direction, and the downtrend still continues. So here you can like sell. That's true, the value of the momentum indicator is fine again. And when the market also, so there is this breakout in momentum, the breakout happened earlier. Similarly here it happened earlier, makes sense. The down breakdown happened earlier in the momentum and then it occurred in the price. So that means it is leading the price, so you can buy or sell accordingly. Some traders regard crossing above the zero line as a buy signal and a crossing below the line as a sell signal. See circles. A moving average is helpful to confirm trend changes. The momentum line peaked before the price sees arrows. Closing below the zero line. So that means it is a sell signal. Ah, this is a buy signal. The momentum line peaked before the price. The some traders regard a crossing above the zero line as a buy signal and a crossing below the line as sell signal. And moving average can help you to stay in the trade. Okay. The need for an upper and lower boundary. One problem with the momentum line as it described here is the absence of a fixed upper and lower boundary. It was stated earlier that one of the major values of oscillator analysis is being able to determine when the markets are in extreme areas. But how high is too high and how low is too low on the momentum line? How can we figure it out? The simplest way to solve this problem is by visual inspection. Check the back history of the momentum line in the chart and draw horizontal line along its upper and lower boundaries. These lines will have to be adjusted periodically, especially after important trend changes have occurred, but it is the simplest and probably the most effective way of identifying the outer extremities. So basically we are drawing the range of the momentum, and that is our upper and lower limit. This is overbought above the zero line, too far from the zero line, and too below the zero line is oversold. We have already understood it. A visual inspection, the analyst can find the upper and lower momentum boundaries that are suitable for each market. See horizontal lines. These are the horizontal lines. This one and most probably this one, I guess, which is marking the range of the momentum. Again, in this case, a 13-week momentum line on a weekly chart of treasury bonds. 13-week momentum again. So basically the highest point of the momentum line and lowest point of the momentum line, then we are drawing it in the shape of a range, and that is there. 13-week momentum line or a weekly chart of treasury bond. The arrows mark the turning points from momentum extremes. The momentum line changed direction before the price at each major turn, point 1, 2 and 3. The momentum line changed direction before the price at each major turn. So from here the uptrend started, and from here the downtrend started for a while, and from here the uptrend started again. So it is shown in momentum first and then in price. Measuring rate of change ROC. To measure the rate of change, a ratio is constructed of the most recent closing price to a price a certain number of days in the past. To construct a 10-day rate of change oscillator, the latest closing price is divided by the close 10 days ago. The formula is as follows. See, don't focus a lot in the formulas. Alright, we are not learning maths over here. We're just understanding the indicator, and we'll just read through it, and if we can get the reasoning behind it, that is more than enough. Because when we are putting on the indicator in our actual trading environment, we are not supposed to do all this calculation. All we have to do is just mark an indicator, or apply an indicator, and it will do all the mathematics for you. It will give you a buy and sell signal, and you have to move accordingly. So all you need to know is what a particular indicator is, what is its significance, and how it is calculated. Like what is the reason of this getting calculated, like how exactly it works. That is more than enough. The actual calculation part, computer is already doing it, right? So here they are telling the formula, even though you can go through the formula once, but you're not supposed to make a lot of notes around it. That is not the important part. If you can just understand the reasoning behind it, that is more than enough. Rate of change is 100 v upon vx. Again, v is the latest closing price and vx is the closing price x days ago. V is the latest close and Vx is the closing price x days ago, right? So we are identifying the rate of change, ROC. So 100, we are multiplying 100 V by Vx. So yeah, that's how it is fine. In this case, the 100 line becomes a midpoint line. If the latest price is higher than the price 10 days ago, prices are rising. The resulting rate change value will be above 100. If the last close is below 10 days ago, the ratio would be below 100. Charting software sometimes uses variation of the preceding formulas for momentum and rate of change. While the construction techniques may vary, the interpretation remains the same. Alright, so 100, if this value will be above, like this value will be higher and this is lower, so it will be like the ratio will be more than 1. So the value will go above 100. If this value is lower than the denominator, so it will become negative and the value will become below 100. Right. So for an example, let's say v is 2 and vx is 1. So 2 divided by 1 will become 2. So the value 100 into 2 will become 200, which is above 100. And similarly, if let's say the last closing price is 1 and the closing price x days ago was 2, so it will become 1 upon 2, which is 0.5. 100 into 0.5 will give you the value 50, which is below 100. So in the case, the 100 line becomes the midpoint line. If the latest price is higher than the price 10 days ago, prices are rising. So it will tell you that the rate of change is positive. That means the prices are rising. The resulting rate of change value will be above 100. If the last cost close is below 10 days ago, the ratio would be below 100. Charting software sometimes uses variation of the preceding formulas for momentum and rate of change. While the construction techniques may vary, the interpretation remains the same. Construction Constructing an oscillator using two moving averages. Alright, so we have already understood what the moving averages are. So basically it is average, but why we are saying it is moving? Because let's say if we are finding out the simple moving average of the last 10 candles, so that means we are considering the last 10 candle. If a new candle is made, so we'll have to subtract the 10th candle, like the initial candle, and we have to add on the latest one. So that's why we have to find out the moving average. Alright, so yeah, that's the reason behind it. Now we will we'll understand it better in the next live. So yes, we are at the page number 222 and we will start from constructing an oscillator using two moving averages. Everyone who have been here, make sure that you are liking and subscribing to the channel, liking the live stream and subscribing to the channel if you have interest in stock market and finance. And for more such content, you can subscribe as well, again if you feel like it is adding value in your life. And we'll meet next time. Till then, stay healthy, stay safe, please take care. If you're into stock market, don't forget to subscribe. Okay, so take care, have fun. We are at the page number 222 and we will start with this topic in the next live stream, which is constructing an oscillator using two moving averages, page number 222. Thank you so much, universe. Thank you so much, Radharanji. Have fun. Peace out.